In a world where your morning latte costs more than yesterday's lunch, rising interest rates barge in like an uninvited guest who raids your fridge and leaves a mess. The Federal Reserve, playing economic chess master, cranks up rates to tame inflation, but it's everyday folks, juggling bills, dreams, and maybe a side hustle, who feel the pinch. It's as if the economy slapped a premium price tag on just existing, leaving us scrambling for a coupon code. Yet amid the groans, there's wisdom to uncover. This article dives deep into what climbing interest rates mean for you in 2025, blending hard numbers, timeless strategies, and a sprinkle of humor to keep the financial gloom at bay. From pricier loans to smarter savings, here's how to navigate this new normal and come out ahead. Why interest rates are climbing in 2025. Interest rates are the economy's thermostat, cranked up to cool runaway prices. In September 2025, the federal funds rate sits between 4.25% and 4.5%, steady after 3 cuts in late 2024. This benchmark ripples through every financial corner, from car loans to credit cards, as banks pass the cost to you. Inflation, at 2.7% year over year, is down from its peaks but still pesky, prompting the Fed to hold firm. Unemployment hovers at 4.2%, while GDP grew at a solid 3.3% annualized rate in Q2 2025, a resilient economy, but one where higher rates aim to prevent bubbles. Imagine a line chart tracking the federal funds rate. From near zero in 2021, it spiked past 5% by mid-2023, eased slightly last year, and now plateaus. For everyday people, this means borrowing stings more. Total household debt hits $18.2 trillion, up from pre-pandemic levels, with credit card balances alone at $1.2 trillion. Delinquency rates on cards climbed to 7.04% in early 2025, as average rates hit 21.16%. The Fed's acting like a strict parent cutting our allowance, but we're the ones stuck with the financial hangover. This isn't new, rates cycle like seasons. In the 1980s, they soared to 20%, crushing borrowers but taming inflation. Today's rates are milder, but the sting is real. For a family with a $30,000 auto loan at 7%, monthly payments are $594, up from $500 at 3% a few years ago. That's $2,064 more annually, enough for a vacation or emergency fund. Trending tech like AI-powered budgeting apps helps here. These tools, part of 2025's embedded finance wave, track spending in real time, flagging overspends. A key index, the debt-to-income ratio averages 11% of disposable income, below 2008's 13% but rising. Evergreen point, understanding rate cycles prevents panic. When rates rise, prioritize needs over wants. Your wallet will thank you. Call to action, check your budget today. Download a budgeting app and identify one expense to cut, like that third streaming service you forgot about. Satirically, while the Fed plays economic whack-a-mole, you can dodge the hammer by staying sharp. The borrowing squeeze, loans, mortgages, and debt pains. Rising rates make borrowing feel like signing up for a financial obstacle course. Mortgages are a prime example. The 30-year fixed rate averages 6.56% in August 2025, up from sub-3% lows in 2021. A 1% rate hike cuts buying power by about 10%. For a $500,000 home, payments at 3% were $2,108 monthly. At 6.5%, they're $3,160, a $12,624 annual jump. No wonder home sales slump, with existing home sales down 2.7% month over month in June 2025, despite median prices hitting $435 to $300. Satirically, affordable housing now means, hope you inherit a mansion. Picture a bar chart. Mortgage delinquencies at 3.7%, the highest since 2015, alongside auto loan delinquencies at 164% for severe cases. Consumer debt balloons. Auto loans total $1.67 trillion, up 2.5% yearly, while personal loans average $11,631 per borrower. Higher rates amplify this pain. Credit card rates at 22.25% mean carrying a $5,000 balance costs $1,113 in interest annually. Financial stress, a major distraction, slashes productivity by 61% for 1 in 3 workers. costing the economy $450 to $550 billion yearly. Evergreen advice: tackle high-interest debt first. The avalanche method, paying off highest-rate debts, saves thousands over time. For example, clearing a $10,000 credit card at 22% versus 15% saves $700 annually in interest. Trending fintech, like AI-driven debt apps, analyzes your habits and crafts payoff plans, cutting interest paid by up to 20%. A key index: charge-off rates on consumer loans rose in Q1 2025, signaling defaults as rates bite. If you're feeling the squeeze, subscribe to our channel for weekly tips to outsmart financial traps. It's free and could save you thousands. Practical steps help. Refinance variable rate loans to fixed ones before rates climb further. At 6.56%, locking in now shields you. Consolidate if your debt-to-income ratio exceeds 36%. Use online calculators to check. Satirically, while we're all tempted to splurge on retail therapy, high rates remind us to shop smarter. Another trick: negotiate bills. Studies show 70% of people who ask for lower credit card rates succeed, saving $200 to $1,000 yearly. Call to action: list your debts today. Prioritize the priciest, and call one creditor to negotiate a lower rate. Savings and investments: the silver lining. Rising rates aren't all doom, they're a boon for savers. High-yield savings accounts offer up to 4.46% APY, crushing the 0.39% national average. Deposit $10,000 at 4.35%, and you earn $435 yearly, versus $39 in a standard account. With inflation at 2.7%, real yields stay positive, outpacing price hikes. Satirically, it's like your money finally got a side hustle while you binge-watch your favorite series. Visualize a pie chart. Of $18.2 trillion in household debt, savings could offset strain. Focused financial habits mirror workplace gains. Engaged teams see 21% higher profits. Stock markets wobble under high rates, but 2025 forecasts predict 5 to 7% growth if cuts resume. Trending blockchain and AI and fintech enhance this. Apps personalize investments, applying the 5-hour rule of deliberate learning for 10x returns. For instance, robo-advisors managing $100,000 can yield 8% annually, versus 4% in low-yield bonds, adding $4,000 yearly. Evergreen takeaway: start saving early. Compound interest is your silent partner. A 25-year-old saving $200 monthly at 4% grows $144,000 by 65. At 0.5%, it's just $96,000. Measurable: businesses using AI tools boost productivity 6%, mirroring personal gains from smart investing. Trending tech like decentralized finance platforms lets you stake assets for 5 to 10% yields, though risks remain. Call to action: open a high-yield account today, automate $50 monthly, and watch your nest egg grow. More opportunities: certificates of deposit lock in 4.5 to 5% for 12 months, safe bets as rates plateau. Treasury yields near 4% offer low-risk options. Satirically, while we're tempted to YOLO into crypto, steady savings build real wealth. Data shows 60% of Americans lack $1,000 in emergency savings. Don't be that statistic. Another index: savings rates rose 3% in 2025 as rates incentivize thrift. Start small. Redirect one coffee run weekly to savings and see the impact. Navigating 2025: strategies for everyday resilience. Rising rates demand savvy navigation, like dodging potholes on a financial road trip. Refinance strategically. At 6.56%, fixed-rate loans shield against future hikes, though mortgage delinquencies at 0.9% warn against overborrowing. A dashboard chart could show financial noise, unnecessary spends, dropping from 60 to 20 monthly via budgeting apps, boosting savings 40%. Trending regtech and quantum computing and fintech fortify cybersecurity, protecting against fraud amid $588 billion lost yearly to poor productivity. Adopt the 5-minute rule for spending. If a purchase doesn't add value in 5 minutes, skip it. This mirrors Steve Jobs' signal versus noise philosophy, cutting financial clutter. Economic slowdown looms. GDP forecasts dip to 1.4% for 2025, but evergreen habits like budgeting endure. AI tools craft hyper-personalized plans, cutting grunt work 4 hours daily. For example, budgeting apps reduce overspending by 15%, saving $1,800 yearly for the average household. Satirically, while we're tempted to manifest wealth, real progress comes from planning. Another strategy, side hustles. Gig economy platforms report 20% growth in 2025, with freelancers earning $1,000 to $5,000 monthly. Use high-yield accounts to park earnings, compounding gains. Measurable. Engagement drives 21% higher profits. Apply this to personal finance by reviewing weekly. A bar chart might show pre- and post-budgeting savings, with green bars doubling after discipline. Call to action. Audit your finances this week, share one money-saving tip in the comments, and commit to a side hustle or savings plan tomorrow. In closing, rising interest rates are a double-edged sword, pinching borrowers but rewarding savers. Evergreen wisdom: live below your means, invest smartly, and adapt fast. With 2025's AI fintech boom, tools empower you like never before. Your financial future hinges on action. Start now and turn rates into opportunities.